success, you actually have to be focused on short-term wins, short-term gains that provide a lot more control and confidence because of the consistency that you can get that starts to compound, right? And the only way you can achieve consistency is by having a very accurate, objective analysis model that provides you sort of like a 360-degree view of the risk profile and the opportunity profile of anything that you're looking at, that you're assessing, that you would be interested in, specifically in the financial markets, obviously, that we're talking about.
There are probably almost as many trading systems and investment philosophies as there are active traders, each strategy promising to help people beat the market. But what if success was less a matter of a system or a strategy and more a matter of a certain mindset? I'm Jane Singer, and you're listening to A Seat at the Table. Each week, I sit down with industry leaders, entrepreneurs, innovators, and authors who share their experience, expertise, and insights into succeeding in business. Roger Khoury has over 2 decades of experience in the field of market forecasting. In 2010, he developed an innovative, probability-based form of price forecasting called market vulnerability analysis to overcome an inherent flaw he discovered in all trading systems and strategies, which he felt was the root cause of large drawdowns and inconsistent results. His approach focuses on limiting downside market risks without limiting upside profit potential, while maintaining a consistent win rate. Roger is passionate about helping traders and investors understand how they can achieve sustainable and consistent earnings. In 2019, Roger launched the Market Forecasting Academy to accomplish his vision for educating and mentoring active market participants on acquiring the skill of accurate and objective financial market forecasting. Before we get started, if you're looking to develop knitwear collections that will be a hit in any market, then Spin Expo is the place to go. It's the primary exhibition for yarns and knitwear. The fair is a rich resource featuring well-edited, high-quality collections, as well as cutting-edge technical innovation, not to mention outstanding trend information that cannot be found anywhere else. You can learn more at spinexpo.com. That's www.spinexpo.com. There's also a link in the show notes. And check out our website. You can find all of the previous episodes of A Seat at the Table, the show notes, productivity tips, and lots of other useful information. You can find it at seat.fm. That's www.seat.fm. FM because it's a podcast. Now let's sit down with Roger and hear about how we can develop the right mindset for winning in today's market. I'm so thrilled that you're able to be on the show because I think that this is exactly the right time to be talking about your specialty, which is investment strategy. And I think that, if you look at the current investment environment or how it's been for, I guess, a fair number of years, a lot of it appears to me, and I am not an expert on investing, but it appears a lot of it has been focused on quick wins, finding that unicorn, getting from startup to IPO as fast as possible, driving huge year-on-year growth. Yet investors with a long track record of success, at the moment Warren Buffett comes to mind, tend to tout taking a slower, more long-term view. So you look at both sides of it and you wonder how to square this. And your philosophy seems to be more focused on long-term success. So maybe we can, start off by diving into your views on investment strategy.
Absolutely. So, what's interesting is there's a little bit of a counterintuitive approach to what I do that makes it work so well.
Okay.
So to have long-term success, you actually have to be focused on short-term wins, short-term gains that provide a lot more control and confidence because of the consistency that you can get that starts to compound, right? And the only way you can achieve consistency is by having a very accurate, objective analysis model that provides you sort of like a 360-degree view of the risk profile and the opportunity profile of anything that you're looking at, that you're assessing, that you would be interested in, specifically in the financial markets, obviously, that we're talking about. So let me give you an example. If you were to go buy a diamond, right, would you only look at one facet of the diamond or two facets of the diamond, or would you look at all facets of the diamond to ensure that you don't have any flaws there that would affect the value of the diamond, right?
Yes.
So we want to look at everything. What's interesting is the majority of what both professionals as well as self-directed individuals in the financial industry, what they do is they focus on primarily two aspects of analysis in the market, and that is fundamental analysis and technical analysis. Well, but there's actually 8 major forces of supply and demand, and most people don't really take those into account, at least not in any meaningful way. So that leaves an investor, a money manager, a fund to be blindsided by 6 other forces of supply and demand that can overwhelm and shift against what their objectives are, because they were only looking at a couple of aspects of that analysis, right? So what happens is with professional funds, they'll focus on the long term and say, well, since the markets will always rise, inflation is always growing, what they do is they're willing to hold onto a market that goes down 10%, 15%, 20%, even 30%, right? And they'll say, well, it's going to recover. But the problem is when you have a market that's in a bull run for so many years, like we've just witnessed, it's you get all these bull market geniuses. They all kind of look good and they have this track record. But when you look a little bit deeper, you realize, well, wait a second, you're holding on to all the big dips that are occurring. Is that the most efficient way? Now, what happens when the market shifts? What if we go into a bear market? What about when a crash occurs? What do you do then? Most people don't think about being able to navigate through a market that shifts against them. What do you do then? You can't buy in hope. That's not a strategy. Hope is not a strategy. You need an adaptive approach that allows you to actually navigate throughout all market conditions. And so what I've serendipitously had events in my life that brought me to an insights that enabled me to go and figure out that there's 8 major forces. And that's how I developed market vulnerability analysis. And that allows me to see the market in all of its different aspects from a risk profile. And that allowed me to forecast risk very accurately. So let me give you an example to help you kind of understand that. And then I think you might probably have a question to ask. Just like you and I can't go outside under a clear blue sky and have it suddenly rain over us, right? Thunder and lightning. It takes clouds to roll in, and it takes a certain environmental pressure to cause the clouds to produce rain, right? Well, those things are things you can identify, and they take time to build. And because of that, that makes them forecastable. So we can forecast poor to bad weather very accurately, so we can plan for it and take defensive action. Well, in the market has all these 8 environmental factors. When you look at them in all together, rather than 1 or 2 out of the 8, you look at all 8 factors, you can now accurately forecast poor to bad market conditions that are evolving that make it conducive for the market to crash or correct significantly. That allows you to become more defensive. And so having investment capital is one thing, making gains is one thing, but knowing how to keep it is another. And this is what allows us to keep it and have a steady approach that's consistent.
I think that's really interesting. Maybe you can share what you see as the 8 forces.
So you've got people focus on fundamentals and technical analysis, but then you've got market sentiment, okay? You have imbalances in supply and demand. So you want to be able to see where those imbalances are. And by the way, any of those can have a little bit of a larger weight on the market at certain points, and others not so much. But that's why we want to look at every aspect. You've got volatility, okay? You have what I call prime pools of liquidity. Those are areas in which the market can actually be manipulated by those who've got some heavy pulling power, right? So that's where people who have experience in the market, they'll feel like the market's very personal. It's coming after them. It comes and hits their stop loss, and it goes beyond them. That is something that you can identify, because those who are in the market who can see order flow, such as your market makers, your brokers, investment banks, they can trade against their own clients' capital because they can see where the orders are, and they know there's pockets where they can, if they can put their liquidity in, they can influence the market a certain way, and then get a better price average for themselves, leaving the people who don't know about this in the dust, right?
Right.
You've got those. You have market sentiment, right? You have the geopolitical impacts. You have liquidity levels, which includes order flow and trade flow. So those are the other 6 out of the 8, right? So when you include fundamentals and technical analysis in all of its forms and all of their subsets, those are the major forces of supply and demand. And if you look at those together, they provide a very clear and accurate picture where you can tell this is a time in which the odds are stacked favorably for my interests in the market versus that's 50-50 or 60-40. Those are not great odds. Maybe I should stay out. And then what happens is you start to achieve a very high 80-90% level of accuracy in terms of your decisions being right. You're right 8-9 times out of 10. And that level of accuracy, when you can get it in real time as market vulnerability analysis allows you, what you do is now you've inverted the risk reward paradigm where everyone knows that if you want more return, you have to be willing to absorb more risk, right? You have to endure more risk. That means being a bit more aggressive. But if you don't want risk, you're risk averse, then that means you're willing to accept less return. Well, with market vulnerability analysis, you actually can limit and restrict your downside risk. You're controlling that without limiting or restricting your upside profit potential. So you can have a very conservative approach, a focus on capital preservation without giving up the upside.
We're going to take a quick break now, and then we'll be right back.
We were hiring when we were making 50 to 100K monthly losses.
And why? Welcome to episode 1.
I can't think of a single founder who's been around for a decent amount of time in business who hasn't had their tunnel of year. This was that year. We're going to be okay, yeah, Khoury. Some are going to hear this and think, you TDP. But hear me out. You only have to do the math to understand that very soon we were $500,000 down.
Wow. I think everybody would want to have something like that. How did you get into investment strategy? I mean, before we continue, I'm just curious how you started with this, how you developed your market vulnerability analysis.
So I got started in the market back in the mid-90s when the whole online trading revolution started. And so I spent 14 years trying to figure out how to be consistent, because every time I would invest in a training or an education or a software or an indicator or a strategy, it would work for so long and all of a sudden it would stop working. It would either start to perform inconsistently or not at all. And then I'm off looking for the next new thing. And that was the cycle. And actually, really turns out that is just the nature of the beast. And one day I had just something intuitively occur to me that I thought, well, wait a second, there's got to be a principle-based approach to this that isn't a variable. How do I figure that out? And one day I was very upset and I almost punched my computer monitor and broke it. And I went out to the beach and I was looking at a bunch of surfers and I don't know, I just started counting the surfers, and I think I was just kind of distracting my mind from the anger I was boiling inside. So I'm counting, and I count. There's all these surfers, and there's a couple that were kind of off to the side, where there was a bunch of these 15 surfers, and they're taking wave after wave trying to surf the ocean waves, right? And they're crashing and burning, and sometimes they get good rides. But these two on the side, for the first little bit, I thought they were the amateurs trying to learn from the others. But I noticed a pattern after about an hour or so. Every time they would get on a wave, they'd have a really nice, smooth ride. And I thought, that's interesting. And it hit me. I said, wait a second. Those are the professionals, and the majority here are the actual amateurs. The professionals have figured out a way to filter out what waves are not worth riding. And so they were focused on not catching every wave that has a likely opportunity to ride, they were looking for waves that were not likely to be bad experiences. And I thought, that's it. So I rushed back home and I began to focus on, rather than looking for opportunities in the markets to make money, I instead began to focus on opportunities that were not likely to lose money. And everything changed. And I began to look at, well, what are the factors affecting that? And that's how I came to figure out there's 8 major forces in the market. And so actually what I do is not a strategy. It's interesting. What I do is I can utilize a strategy. And let me give you an example.
Okay.
So for instance, let's say every time the market kind of reaches a bottom, it goes down a little bit and hits a price level that kind of bottoms out and it bounces off and goes up. And let's say it comes back down a second time, that same price level, we call that a double bottom. So it bottomed twice at the same price level, and then it starts to want to come back and go up again. So if your strategy is to invest in every double bottom, if you see 100 double bottoms, you don't know beforehand which one is going to work out and hit its target and which one's going to struggle and fail. So you just take all 100. And let's say that produces a 60% edge or 60% advantage. So you're going to be right 6 times out of 10. Wonderful. Well, here's what's neat with market vulnerability analysis. It takes the strategy and enables you to actually filter out and identify before you commit which of the 100. So if we have a 60% edge, you're going to have 40 losers, you have 60 winners. So it'll tell you out of the 40, with no less than an 80 to 90% accuracy, which of the 40 losers are likely to struggle and fail before you commit, so you can filter them out of your experience, and you're left with 4 to 8 out of the 40 that you would have normally taken that you would take as losers. So think about that for a second. That gives you, if you took only 4 or 8 losers out of the normal 40 out of 100 opportunities, you'd be trading a total of 64 to 68 times, right? Or taking 64 to 68 positions out of 100. So you're involved in the market much less. But look what's happened. You've decreased your losers. So 60 out of 64 to 68 positions that you would have taken leaves you with between an 80 to 90% win rate on a strategy that only wins 60% of the time. So you've taken what something isn't as, high win rate, but you're forcing it to produce a win rate because you're able to filter out the positions that are not predisposed to follow through and hit the target that you're assessing should be hit. Does that make sense?
So you're really sort of flipping the traditional equation on its head, and you're looking to mitigate downside risk as opposed to trying to capitalize on that upside gain.
Precisely. And by doing that, by knowing how to not lose, by knowing how to keep on and hold on to your gains, you're now able to have a consistency in where your downside is very limited. It's restricted to something you control, and you're experiencing 80, 90% positive experiences because of that filtration that market vulnerability analysis enables the user.
I think that's really interesting, and I think it's very important because I think for so many investors, there are people who have the capability in terms of financial resources and in terms of all the tools to be able to be in a very high risk, potentially high gain situation. But most people who are out there as investors, and particularly retail investors, they really need to be able to manage that downside risk so that they don't end up being wiped out altogether. So,
that's right.
Yeah, I think it's great that you've developed this. So, in a sense, would you say that the system that you've developed is really mitigating market volatility?
The negative aspects of volatility can be good,
right,
when you know how to use it in your favor, such as what we're talking about here. But yes, so the negative kind of volatility that person would experience the stress and the risk from, yes, it mitigates that. It mitigates the downside risks. Think about this: the market has gone up in a way that you've never seen historically. If you've seen the market, it's kind of gone up like this.
Right.
Recently, we've had a market that just kind of went up like a rocket ship. That's not, and the fundamentals don't support that in any way, shape, or form, as you know, especially with what's going on with the pandemic and all of that. So we're headed for a significant correction. Now, I want people to understand, once a person gives back beyond 10% of their investment capital, you start to need more return to come back to break even. And a
Yes.
kind of a clear example is if the market crashes 50%. So if you lose 50% of your capital, you would need the market to basically grow by double. You would need it to double just for you to get back to break even. You're not making any money.
Wow.
So why not avoid that major downturn, take defensive action up at the top, give back a few percent, and then when it comes down, corrects, as you see it recover, get back and ride the gain, and now you're actually growing your capital rather than filling a financial hole that you created for yourself. It's much more efficient to do that than give back years of your life, productive financial growth, in a few days or a couple of weeks. It's why do that? You no longer have to do it with market vulnerability analysis.
So interesting. And I think it's a point of view that hasn't really been championed as much. And like you said, particularly when you're in an economic situation where you're seeing this really high and fast growth, it's tempting, right, to want to ride that wave.
One of the scariest things I get from people is, well, I'm doing fine. I've been generating good returns. Well, now hold on a second. Anybody can generate good returns when the tide is rising.
Right.
So let's not deceive ourselves. You should be prepared for when the market turns. This isn't a forever game. This is going to be a season. When that comes back, it's going to come back with a vengeance at some point. Are you prepared to know how to hold on to the gains you've had, and know how to actually continue to grow despite a downturn? That is the real challenge. And people have to realize that if you've been fortunate with the circumstance, don't don't abuse that. You should really, take a look into, how do I hold on to what I have, right? We don't want to give that back. And we've just seen a recent market correction. Well, we've had a pullback. We haven't had a significant correction, but we had a pullback here recently. I think that should kind of make people wake up and take attention, put some attention to, hey, is this about to change? Are the winds about to shift, right? So we want to be prepared for that.
Yeah, that leads me to something that you've been quoted as saying, which is good returns are one thing, knowing how to keep them is another.
Yes.
So I think that a lot of people would be interested to understand in a little more depth about keeping those returns.
Absolutely. Yeah. And it starts with understanding when the environmental factors are changing and are beginning to be conducive for a significant correction or a crash. And I'll give you an example. People think, so for instance, if people are familiar with Chipotle, Mexican Grill, it's a stock. It was a favorite, and it was just a high flyer. And then one day they had that E. coli breakout, and their stock crashed. Okay, now it's very logical to think that, well, it crashed because of the scare of the E. coli, and that scared investors. Well, I'm here to tell you, and anybody can challenge me on this, and I'm happy to take the challenge. It's impossible for the market to correct significantly or crash in the way that Chipotle did, or any market does, okay, unless the environment is conducive for it to do so. So the E. coli breakout was a trigger that triggered the downturn, but environmentally, several weeks before that occurred, Chipotle was starting to go up on not much. It's like thin air, right? Hot air. You could see that the environment was conducive for a significant shift to the downside, and all it was waiting for was a trigger. And so if that environment was not there, what you would have seen instead is the E. coli breakout would have occurred. You would have seen a dip that would have been just a few percent. And then if it was going to snowball, you would have time to take defensive action and get out before you take a major hit. It wouldn't be the sharp crash that people experienced, because the environmental factors weren't there. They'd have to develop within the 24-hour period to 48 hours of that news hitting the market, right? But when you have a trigger and then all of a sudden it's a sudden collapse just like that, and people are shocked with a 10-14% crash in a matter of a few hours, that was an environmental situation that allowed the stock to crash that way. So I think people have to remember that, just like with weather, the further your forecast is for poor or bad weather, the further out you go in time, the less accurate you're going to be. The closer you are in time, the more accurate your weather forecast of poor to bad weather is going to become, and more helpful to you, right? So the closer you are, more accurate. The further you are, less accurate. So that should be a hint to everybody. Today's environment, we're no longer in these big industrial cycles like Warren Buffett experienced when he started investing that enabled him to be Warren Buffett.
Right.
Today, the cycles are very different. And today, longer term focused investments are actually more speculative when you have market vulnerability analysis on your side. Now, without it, I get it. You don't have the level of accuracy in real time on the short time frames. But you really have to realize that speculative investing now, it's actually associated with the longer term because we have less visibility on what's going to happen in the future, especially with what we're dealing with right now with these massive changes occurring economically, globally, because of the pandemic. So the shorter time frames are more accurate. You have much more control, and that takes a little bit of a skill, which anybody can learn. I like to empower people. I want to teach people how to fish for themselves rather than be fed fish, right?
Right. Yeah, exactly. You talk about focusing on the process, and I think that's particularly interesting, particularly in today's environment, as you've been bringing up. We're in a very volatile time. We don't know what may be coming after. Maybe we're, going to be heading into a more peaceful and more stable time, let us hope, but we don't know. So can you dive in a little bit into what you're talking about in terms of focusing on the process?
Absolutely. So a lot of people are inherently focused on the result, the end result. I want to earn, I'd like to shoot for, if I can make 15 or 20% a year, I'd love to make 30 or 50% a year if that's possible. But, well, that can cause you to go like this, go from funnel vision to tunnel vision. Now, I want you to think about when you're running late to an appointment and you're driving your car. Now, you know the rules of the road, you know how to drive a car. But suddenly, all the things that you're supposed to do, you start to kind of rationalize why it's okay not to do them right now. You just got to get through that intersection and get to your appointment, right? You start to drive the car differently, okay, because there's pressure under you. So what's happening is when you're working under pressure, you're going to behave differently than if you weren't under pressure. Ironically, when you actually put a goal that you want to achieve, there's a certain sense of pressure to achieve it. None of us like to fail.
Right. That's very true.
Now, that blindsides us from what we should be seeing. If you think about when you're driving more aggressively, you're pushing the envelope, the risks begin to increase dramatically that you're going to get into an accident or get pulled over and get a ticket from a police officer. Now, in the market, especially with financial things, that feeling, that emotion is exaggerated. So we don't want to go to the market and say, I want to earn, or my goal is to make X per day or per week or per month or per year. No, instead we want to latch onto a process that's been proven, that is objective, that is accurate, like market vulnerability analysis, and focus on applying the process diligently and properly, because the process is what will deliver the results. And if you focus on the process and not the results, what you'll find is your results will actually be much better than what you're hoping or expecting by just focusing on that process, because it's me applying the process diligently is going to give me what I want at the end. So people find, they come to me and say, well, I would like to earn X per year on my money if I'm putting my time into it. What's important is they focus on applying the process for themselves to identify what they want to be involved in and what they want to avoid. Well, here's what happens. Not usually. In 10 years of teaching people, I've never had a single person apply what I teach them properly where I haven't seen them beat what they were hoping for when they first met me.
When the market is going up the way it has been, it's very easy for people to be lured in and to probably be a little more aggressive than what they should be able to handle, right?
Correct. Correct. And you no longer have to be aggressive. It actually, by being conservative, focusing on capital preservation and using the market vulnerability analysis to enable you to take advantage of opportunities to have, basically better than, the market average, beat the market, while not taking on more risk to do so. That's a game changer, right?
Oh, absolutely. I think that increasingly more people are becoming more risk averse.
Yes.
And to be able to understand how you take that point of view and actually turn that into, I don't know what you'd call it, a superpower maybe.
Yeah.
I just have one more question.
Sure.
There's a saying that many people like to quote, and that is that fortune favors the bold, which
Yes.
I suppose encourages people to be a bit more aggressive in things and take more risk. So how would you sort of address that, given what you've said about risk management and being risk averse?
Absolutely. Ironically, this approach, where you need to be bold, is to be willing not to be afraid of yourself, that you can learn this, that anybody can learn this, anybody can do this. It doesn't require a certain experience, intelligence level, background. Be bold to take matters into your own hands and learn something that's going to allow you to have a skill set that will allow you to navigate your financial future with confidence, with consistency, in a sustainable way, and without putting yourself in an aggressive situation or a stress-filled situation. This is taking away the stress. That's where you need to be bold, is in taking a step out and grabbing control and learning something that you can use for the rest of your life. That's number one. But when it comes to the methodology, approaching the market with the model that I've developed, it's an innovative first, and it flips everything on its head. So in this case, you don't want to come to the market looking for opportunities to make money.
Right.
You come to the market looking for opportunities that are not likely to lose money, and you let them kind of like essentially fall in your lap. You don't want to go chasing money, chasing opportunity. And the funny thing is, when you allow it to come to you by just being present, right? Be prepared. You sit and you look, and it's not, getting buzz-eyed like that, looking at the screen all day. It's not like that. You do some analysis. Doesn't look like there's anything. Remember, you're forecasting. This is a forecasting model with an 80% or higher accuracy. So you're going to be right 8, 9 times out of 10. You look, if you're forecasting there's nothing going on, you can read a book, you can check your email, you take it, you glance, and you're going, no, not yet. You
Right.
sit back, and you're only doing that for a few hours a week. That's all it takes. And out of that time, what's going to happen is, here's a situation. You get in, it's peaceful. It's not stressful. You see it. It's objectively in your favor. It's predisposed to do what you want it to do. The odds are stacked in your favor. You take it. You hit your target. You see clearly. Okay, yep, I'm done. You're out, and then you're on the next thing. It's not the stressful wrestling war zone.
Right,
It's not
right.
playing on your emotions. That's how this works. And so when people come and they realize it's the process that's enabling them to outperform the market without the stress and the volatility, that changes everything. And that's how people should approach this.
So is this specifically based on analyzing the stock market, or is this something that would be applicable to other markets, whether it be financial markets or anything else?
It's a great question. So as long as you can put it on a chart where,
Right.
how you can chart prices,
Yes.
whether it's crypto, futures, commodities. There are a lot of guys that like to be involved with options, and you have to understand how to forecast and analyze the underlying asset if you want the successful options position, stocks, the indexes. So anything that you can put on a price chart, it doesn't matter. This thing is agnostic. It doesn't care what you put, and it doesn't care what time frame, doesn't care what market or asset class or symbol. I will say this though. With stocks, at least in the United States, you're going to pay the most in taxes. If a person simplifies their life, and I always encourage, hey, simplify your life. Look at one symbol. You can make an entire living on one symbol. Pick a symbol in the futures market, because in the futures market, the first 60% of your profits will be taxed at a flat rate of 15%, and the balance of your profit will be then taxed at your regular tax bracket. So usually your total tax bite on a futures profit, if you're trading the futures market, it's going to be around just a little over 20% versus 40% in taxes at the end of the year. So it's very efficient that way. And you don't have to sit and analyze a bunch of stocks if you don't want to. Some people like to do it. But I always say, hey, pick something that you like. One thing that's liquid, that can handle the amount of money that you've got in your brokerage account. You pick one thing and you look at that, in the morning, in the evening, whenever you want, and that's it. Keep it simple. I'm all for keeping it simple, very efficient, and that will provide them more than what they're expecting.
I think that makes a lot of sense. Is this a philosophy, or is it an actual software app?
So actually, it's both philosophy, but it's predominantly a process. It's a process of analysis. So it's a framework that tells you, here's the things we look at to assess objectively whether something is actually predisposed favorably for what you are assessing the market should do. Are the odds stacked in that favor or not? Are the odds 60-40, 70-30? Are they 80-20, 90-10? What is it? What are the odds of this working out? And you're filtering yourself out of the things that really are not 80 or 90% stacked in your favor, right? And that means you're saying no more often than you're saying yes. So it's not busy work, okay? It can get a little bit boring because it's, you're just waiting for something to kind of fall in your lap. That's kind of the trick here, is kind of being patient to let it come to you. And by doing that, you find that it's able to give you consistent profits that start to stack and compound. And that produces a level of performance that people can really take to the bank. It's very reliable. So really, it's a process. It's a philosophy. The software is just it's a charting platform that allows you to just do the visual analysis, so you can see very quickly where the market is fueling to go and where there's not enough fuel for the market to go. It tells you what's happening directionally and environmentally. Is it going to be volatile? Is it going to be choppy? Is it going to go sideways? Is it going to go down? Is it going to go up? It gives you all that objective data, and with what odds that's going to happen. And so one of the hardest things for people to kind of accept is, well, Roger, you're teaching me how to forecast. So if I can forecast the market, can't I be in the market all the time? No, because most of the time the market is actually not favorable. It's stormy. There's a greater level of uncertainty, and you'll be able to assess that. So if you can forecast a storm is coming and you're in the middle of a storm, that doesn't mean that you should be out running errands in the middle of a storm. That's actually instructing you that, yeah, your forecast is correct. You can forecast, but you should be indoors waiting for the storm to pass and then go out and run your errands, right?
Yes, yeah.
That's the key. So we're only in the market when there's a high probability to hit our target, but at the same time, where the experience along the way is not something that's stressful, that puts me under pressure, that causes me to start to behave in ways that wouldn't be helpful, that wouldn't serve me, right? When you're under pressure, you know how to drive a car, you drive the car differently, you're more prone to make mistakes and get into an accident. In the markets, you're under pressure, you might know where you're going, you know where your target is, you know what you're forecasting, but you might make mistakes. Poor judgment starts to occur when we're under pressure. So we know how to avoid those. And that's the wisdom of the philosophy behind applying the process diligently.
So interesting. And I think you've made so many excellent points here. If people want to get in touch with you, and I know they will, how do they contact you?
So one of the best places to go is actually raise your financial IQ, just the letter I, the letter Q, .com. RaiseYourFinancialIQ.com. Okay. There's a case study there.
Very interesting. Roger, thank you so much for sharing all of this. I have learned a tremendous amount, and I think so many people who've listened to this have also. So thanks a lot for taking the time and sharing your knowledge.
Jane, thank you for this time. It was a pleasure to be here.
If you enjoyed this episode of A Seat at the Table, join me each week when I sit down with industry leaders, innovators, entrepreneurs, and authors who share their expertise, experience, and insights about succeeding in business and in life. And make sure to visit Spin Expo. From trend information to technical innovation, Spin Expo is the primary exhibition for yarns and knitwear. The fair provides well-edited forums featuring high-quality products that are bursting with creativity. To learn more, go to spinexpo.com. That's www.spinexpo.com. You can also find the link in the show notes for this episode. And don't forget to check out our podcast website, where you can find all of the previous episodes of A Seat at the Table podcast, the show notes, news about our upcoming masterclass series, and lots of other useful information. You can find it at seat.fm. That's www.seat.fm. FM because it's a podcast. Thank you for joining me today. I'm Jane Singer, and I'll see you in the next podcast episode.